Let's kick off straight away with the interest rate decision by the central bank yesterday. Of course, it is the highest central bank interest rate increase that we've seen since the interest rate was introduced in 2006. Do you think this sends the right signal to the market, and do you think it was enough?
I think the most important thing from yesterday's Monetary Policy Committee meeting was that the central bank came out and offered steps to which it hopes to improve stability and reduce volatility. With regards to the central bank rate being raised by 75 basis points, this was more of a reaction towards the IMF Extended Credit Facility program, where net domestic assets are supposed to be reduced so as to lower the underlying inflation rate. So therefore, with regards to what this effect will have on the market, we are likely to see a short spike in interest rates because of tightening liquidity of domestic credit. We are likely to see a rising exchange rate because what happens is that now, according to the ECF program, foreign assets are supposed to increase as a percentage of broad money supply.
Yeah.
So I think the central bank will be pressured to buy more foreign assets, including dollars, and that will impact on the shilling. And with regards to inflation, given that the bulk of the inflation that we've witnessed this year is supply-side driven, we're not likely to see any significant reduction, but probably in the underlying inflation rate. So I think the most important thing from yesterday's meeting was that the central bank came out and offered at least a path, a guidance for the medium term, that at least now market participants know what to expect from the central bank. And I think that will be a good thing.
And of course,
the rate. Pardon?
And of course, admitting, as you say, that it had made mistakes in the past. I think that's what the market also looking for, saying that those mistakes had caused the volatility.
Exactly. And I think there are mistakes on the CBK's part, but the thing is, I think there was a miscommunication. With regards to the discount window, what they didn't expect that the discount window rate would be now a tool for increasing the interbank rate. The discount window was meant to affect liquidity. So I think such miscommunications are what they're trying to clarify. And I think now that they've communicated their stance going forward, that will reduce the volatility we witness in the markets.
Let's look at local borrowing costs, because we had the yield on the 182-day T-bill rising to 11.935%. Now that's the highest it's been in a decade. Given the surging local yields, can government sustain paying borrowing costs on the domestic front with yields at these high levels?
I think the yields are affecting government borrowing, and it could be dangerous going forward with such high debt servicing charges. But what we are likely to see with the yield front is that once the short trends materialize in the third quarter of this year, around October, we are likely to see inflationary expectations subsiding, and that could now impact the yields. So I think with the yields front, it's really tough right now, but I think they're going to be reduced by the expected rains of October.
Right, let's move on to the equity market. CMC Holdings, there's a lot of conflict going on at board level after the dismissal of the chairman. He's now appealing his dismissal, but this was on the basis of a conflict of interest. Just give us an update on what's going on there.
What we're witnessing in CMC is that the current board, Peter Modhoka, the current chairman, Mr. Modhoka, owns a company called Andy Forwarders, which coordinated the logistics for CMC. According to Mr. Lay, who's the CEO, the invoicing charges were at a premiums of 10 to 30% from Andy Forwarders, and I think this was a bone of contention with the rest of the board members as well as the executive committee. So I think now they recognize that conflict of interest, and they want Mr. Modhoka out due to that conflict of interest. So I think
they had a contract though for 17 years. I mean, surely someone would have noticed that there was this conflict of interest and that they were overcharging by what the new CEO says of 100%.
Exactly, but the thing is, you realize that CMC has been run without any serious modifications to its board structure and executive structure for the last 30 or so years, with a CEO that had existed for 33 years before Mr. Lay took over. So these are dramatic times for CMC, but the changes we're witnessing now are legacy changes with Mr. Lay and the rest of the board members trying to to undo the things that had been done prior to taking over.
And of course, they had a dismal performance in the first half of the year. They now have this new CEO, Bill Lay. Do you think Lay is the right man for the turnaround in the company?
I think so, because Mr. Lay has significant experience in the East African motor vehicle industry. He's got good lobbying skills that would work well for CMC, as he's the CEO of General Motors before then. And I think what investors need to realize with CMC is that they've got some very valuable franchises, including Volkswagen and Land Rover. And I think a change of strategy would be useful, and I think Mr. Lay is one of the kind of people who can implement that change in strategy.
Let's just move on to Uchumi before we end off. They're aggressively expanding in the region, looking to win back their market share. They've come out saying that they're opening 17 new branches in the region. Do you think the share price is going to respond positively to this today?
I think what's really affecting the share price is, I think, legacy issues with Uchumi, because most investors still think of the current Uchumi as the Uchumi that went under receivership in 2006. So I think Dr. Shiano has done a good job reducing the debt load that the company had, restructuring the balance sheet, and ensuring growth, because as he informed us yesterday, they're looking at growing and not expanding. So I think if an investor wants to be exposed to the retail market in East Africa, I think Uchumi is one of the only entry points into that into such an exposure. So going forward, we are likely to see people trooping into Uchumi, because currently it's selling at a PE of around 6, which I think is relatively cheap given its growth potential in East Africa.
And of course, it has been under pressure since relisting this year. Thanks very much for your time this morning, Samora. Samora is from NIC Securities, a research analyst there, Samora Kariuki.